Hey everybody, this is Kashyap. You guys know him. Kashyap and I met a few years ago now, 4 or 5 years ago at I think now actually. And I was reading his stuff, and I've always been an admirer of how he looks at his fundamental analysis. I think he notices things a little bit earlier than most people. And we started chatting, and I've always just enjoyed having conversations with him. We push each other to become better traders, if anything. And he's always kind of helping me to open my mind to certain things. I hope I do the same for him. So starting out, how are you doing today, Kashyap?
Thanks, Jason. I'm doing good. How about you?
Good, good. You just got back from a trip. That was awesome.
Yeah, that was pretty awesome.
Nice, nice. So, kind of going through a couple things. I wanted to start with your approach to trading. So, we kind of talked about something that was to do with getting the shipping trade right. And I want to talk about a couple things. We'll start off with, you're not just trading one sector usually when you're trading. You're usually trading a couple different things, looking at something, because especially lately, like right now with the war thing going on, it's kind of interesting, especially for me being in the commodities trade. I'm seeing so many people kind of come into this. Oh man, look, I look at bonds today. Like that's been today. Oh man, these shorts are getting killed, and it's like, you have, number one, it's like you've been making money on this trade for a while, and then you have all the commodities positions that are doing well, and it's like all these people don't really understand that the way you trade isn't just buying one thing and just sticking with it. You want to be in multiple things in multiple sectors. So what sectors are you in right now, and what are you looking at?
Yeah, so I actually started out with the single sector approach because that's how I got into trading. So I started with gold, then discovered uranium, and then discovered shipping, and just went on from there. And right now I'm looking at shipping. I'm looking at gold again because it's starting to take off. I'm looking at uranium. I'm looking at transports in general.
Hmm.
And I have these other odd trade ideas on. So yeah, I'm trying to get more of that mix of sectors in my portfolio rather than just be the guy on FinTwit who's, just crying about being long or short, the one thing that is not working. And then yeah, because like been there, done that, and know that doesn't work. So that's kind of where I am today. Hey, I'm not able to hear you.
So looking at gold right now, like you said, it's starting to take off. I'm seeing the same things. Something we put out about a month ago now, a couple months actually. I think it was beginning of the year. And we started to see that gold was kind of turning. You kind of noticed it a little bit before for me. Now we're kind of seeing that all the levels that I wanted to see crossed to try to get more bullish on that space got crossed. Now I'm in full buy signals across the board. You're fundamentally saying, some things that are making you bullish on top of it. Not to mention, the fundamentals for gold have been good for a while. It's just the price that sometimes needs to catch up. So now we're seeing all that kind of start to happen. So what exactly are you seeing in the gold and the miner space, especially right now?
Yeah, so I think the largest miners are really strong right now, but it's not trickled down to the rest of the space. And that kind of makes sense because the smaller the company, the more you have these risks to deal with. For instance, a company with a gold mine in Russia right now, right? Like they never know what's going to happen. We have this news of BP and Exxon just writing off their investments, and then you have the issues with sanctions. And the thing with gold is that most of these miners, they are not in safe countries, right? I mean, safe is a relative word, but even then, like their risks are pretty high. And then you also have soaring oil prices, which is going to hit margins for all the open pit mines because they rely on diesel generators to keep their operations running. So all that is kind of having its impact. So that's why we are seeing strength in a Newmont or a Barrick rather than say in the rest of the space, like the 100 million market cap miners or the 200 million market cap miners.
Yeah.
And also, that's how the cycle starts, right? The leaders always start to take off first, and then capital starts moving in. So I think we are just at the beginning of this rally.
I think so as well. And it's something that I think a lot of people always like to hate on gold, like last year. Gold's flat, not really going everywhere, and everybody's going, "Oh my God, gold's dead. Gold doesn't pick up anymore." And there's a couple things about it, which is one is when you have this very new kind of environment, and it's not new. Obviously, we've had inflationary environments year after year after year, but I think the people who traded the last one, it's so long ago. Like, granted, yeah, we kind of had one in the 2000s, but looking at it from back then, nobody's really traded an environment like this in many years. So I feel like people aren't going to get the same signals. You're not going to see it the same way. And not to mention, like, in the grand scheme of things, a year's kind of not a very long time. You saw gold kind of, and gold always does that. And it was one of the first things we put out at Against All Odds Research, which was the fact that gold kind of rings the dinner bell. You got gold moving up big, and then you have wheat, and you got soybeans, and you got corn, and all these things start to move big. And then so gold kind of rings the bell. 6 to 12 months later, you see everything else start to move, and that's kind of what we saw last year. But gold also tends to split up its time between oil. Like, you'll see gold go flat and oil go up, and then gold go up and oil go flat. And also with yields, the yields also usually aren't moving the same degree. If oil is moving down, most of the time yields can move down, and that also gives a boost to gold. So all these things kind of work together. And so I never saw gold as kind of a bad investment at the moment. I just thought it wasn't doing anything, which sometimes that's what you want your gold to do. When everything's going crazy in the markets, like, you want something that's going to just stay valuable, not lose much value. And there's going to be certain times to add to positions, certain times to take positions for a trade. Like, trading obviously is much different than long-term investment. But if we're looking at this breakout that just happened in gold, we're seeing a major band squeeze, and the volatility is crushed like crazy. And then we get this great breakout, and then silver has started to follow. Palladium or platinum, obviously palladium has gone pretty nuts lately, but all these things kind of are moving together in a nice way. GDX also is a buy signal. Most of the miners look even better than the GDX as well. So you're looking at all these things kind of come together for the gold market, and it was something we talked about a bit. And some of the names you named are really running nicely. What's one of them that you're thinking of right now that you like the most? One of the most.
Definitely Newmont, mainly because valuation wise, there's a lot of catching up to do, and also because it's pretty stable. You don't have all these operational risks that, say, a miner like Kinross would have, or even Agnico. Agnico has been one of the best names in the gold space for, I think, the past 4 decades or so, and right now they are going through a leadership transition. So it doesn't look pretty. But with Newmont, you know that, I mean, that's the largest one, so that's where people are going. And also, the risks that are associated with the other names just are not there.
Yeah.
So, yeah.
And Newmont's also getting very close to another new high. So it's you're seeing the strength and relative strength kind of flow into that name over everything else. So it's very interesting to see that market, and so many people had so many issues with certain things, especially with gold. Everybody has been talking about it lately, what we just talked about. So it's kind of watching this kind of play out right now. It's kind of to the point where it's so dead that I would think that it could finally pick up, because that's also the thing that has to happen. Things go through very big bull rallies, like when we have gold, moving from 1500 all the way to 2100, in a few months. And so this huge rally happened, and then they have to die off. And then it was dead for so long, for most people, it was dead for so long that they just finally moved away from it. If you remember, Warren Buffett bought Barrick, and next thing you know, everybody in the world is just running into that stock and talking about it, and all of a sudden gold miners are huge again. And that was the top. That was perfectly timed out, about as well as you could ever get for a top in that market. And so it was, you see this stuff happen over and over again, and you kind of get a feeling for where the sentiment has finally died off. And yeah, there's always the gold bulls that are like, gold is great, keep buying miners, do this forever, and they'll say that no matter what. And that's not the case, like especially with you or me. The point is that it's a very tradable asset class. There's a lot of things inside of it, whether you're looking at the metals itself, whether you're looking at the miners, individual miners. There's a lot of things that are very tradable, ways to make great money in this investment. And I think we're seeing some of the names finally break out right now after this dead period. So it's been interesting. And I think that, so many people now, they just don't expect it. They've seen the rest of the commodities run. Like, today I'm seeing, oil's hitting 100, and finally seeing, I mean, I got so much hatred for the oil trade, how stupid it was, how energy stocks are bad and all this stuff for all this time. And now that oil's $100, everybody's like, oh yeah. I mean, I'm getting messages from people that I haven't talked to in years that are like, hey, how do I get into those commodities? What should I do? Should I just buy futures? Number one, futures markets, like if you're going to start trading, commodities and futures markets where you're going to start, you're probably not going to have a good time there. But if you're looking at the rest of these markets and you're going, okay, well, there is something here, like you should always be doing that. You should always have that on your list, all these different things, all these different commodity based sectors and so on. But plowing into things right as they're on the news finally probably isn't smart. And it's the same we saw in Barrick. Now we're kind of seeing it in oil. I'm not saying that rally in oil is done, and I'm not saying I'm out of my position's still on. My stops are moved up and so on, but that's it. I'm not gonna, I wouldn't start the trade today, but I'm already in the trade. So some of those things, I remember there was a quote by Paul Tudor Jones. He talks about, if I wasn't in a trade, if I wouldn't take that trade today, I wouldn't be in the trade. And for me, like, I don't understand that. I don't think that makes sense for, especially my time frame. I don't think that makes the most sense, because sometimes you have this buffer inside of your trade, and you have this built-in area where you're already well into profit. Now you can take a little bit more risk. You don't want to take a risk when you have no reward on, but once we've been in that trade since $30 all the way up to where we're at today. So, you have all these things kind of taken off, and I really like the way gold and silver are looking. So I'm glad that you're seeing the same things that I am. So let's go into taking shots. So you had this, you had the shipping trade. Excuse me. You had the shipping trade really nailed. To dead to rights. Just basically on point. And Kashyap used to work for somebody that was, and I think that, and I'm bringing this up not to harp on this person, but I think this happens to all of us in trading. You see somebody that's very good at trading, or you think is very good at trading, and you talk to them and you learn from them, and then at some point, they might be saying things that are detrimental to your own trading, or they also have their own objectives, and they're kind of sticking to those. And so, you see this great trade, you talk about it, you really nail it. You find all these names before anybody's ever talking about them. Today, now you're seeing all these, the energy shippers starting to move, and everybody's talking about them on Twitter, but you were talking about it way before that. You put out a presentation, you had all this stuff. And then at some point, before they took off too, you had this guy kind of beat that out of you. So I wanted to ask you about, not exactly like he beat it out of you, but he didn't, he wasn't on your side on the trade, and he was very quick to kind of just dismiss it. And this was somebody he worked with at that time. So I kind of want to talk to you about, that trade, coming back into it, and like what you had to kind of go through to understand, like, maybe you're gonna take another shot at this. And sometimes taking big trades, especially trades like that, like you have a sector that's been in a downtrend for who knows how long, and you're gonna come in and you want to buy that sector. You're seeing value in it, you're seeing all this stuff. You're probably not going to get that trade right the first time. I mean, the energy trade, the first time I took it was the end of 2019. It's very short lived. That was very quick to be in and out of that one. But then taking it in 2020 was a whole different story. So for you, you have this shipping trade that's just crazy right now. So what were you seeing? How did you get into that, and how did you overcome to get back into that trade?
Yeah, sure. So I think I started looking at shipping seriously around 2019. That was right before the IMO 2020 regulations kicked in. So IMO 2020 was a set of rules which encouraged shippers to decrease their sulfur emissions, among other things. So that would have had a big impact on the fleet. So the thing about the shipping industry is that most of these ships were built in the last cycle, like right when China joined the WTO, and we had this huge boom in commodities, like from 2000 to 2007. So that's when most of these ships got built. And by 2008, it was a bear market. And then we had this other mini commodity rally from 2009 to 11. And then the sector just died after that. Like in terms of returns to investors, it just died because it was all debt laden, and the companies are just going through bankruptcy and restructuring, kind of like what we are seeing with the oil services sector right now. So the trade was dead for a very long time. And 2019 was when it looked like the IMO 2020 regulations could clear some of the older tonnage from the market, which means that the pricing power would return. Plus, it looked like we were seeing a new commodity cycle come in, and then the COVID crash happened and economy shut down. The market shifted from demand for goods to demand for services, which is why the tech stocks took off and the trade completely changed again. And then I put out this trade in public, especially the oil tanker part of the shipping industry. I put that out in public in response to the WTA going 37. Of course, that was not the perfect timing for the trade, but it was the perfect timing to write about it and get attention, because that's when people were looking at these stocks, right? You had the news of oil going into storage because there wasn't enough capacity available at the Cushing or the other places where the oil is generally stored. And then the trade looked like it would take off. We got some fat dividends along the way. And somehow the trade just took a lot of time to work. And maybe I didn't see what was coming, which was the fact that oil demand would crater, or that the demand for these ships, once they got out of the floating storage trade, maybe the demand wouldn't return. I really am not sure exactly what happened, but somehow the demand just didn't come about as expected. And then I had to close the trade. And it was also the influence of the fact that I was working with someone who wouldn't allow me the room to let a trade run, whereas he wouldn't mind holding on to a losing trade for a much longer time and justifying it. But I didn't have that privilege, so it was kind of in a way the trade not working as quickly as expected, and the fact that I personally had the pressure to close the trade out before things went south. And then I just gave up in disgust. And it took a while for me to finally just free my mind, get all that clutter out, and then just look at the sector the way the sector is meant to be looked at, without all the biases from my own past hindering my judgment on it. And then when I did that, I realized that yes, this trade still absolutely makes sense. Oil is absolutely going to be essential. Oil transportation is absolutely going to be essential. And the catalyst that I was looking for, all those factors were at work. And the interesting part is just looking at this and looking at the way inflation was going on in the US, and the way you had shortages, you had backlogs at ports. Looking at all that led to another trade, which ended up becoming an even bigger trade than the original shipping trade. So it kind of morphed in between. And I think that ability for me to get declutter from the past and just look at the sector, move on to other subsectors, that really helped me to see the shipping trade better. And that's probably what's led to me putting out all these alerts and reports on the other side of the shipping sector now.
Yeah, and that's the other thing too, is that, I remember us talking kind of about that, and that there was I was talking about that and I'm mainly price action based. And in my in the personal portfolio for myself, especially if it's my retirement, I do buy individual stocks. And we were talking about I was asking you about these different sectors where I had all these buy signals in. And then the oil shippers were not doing the same thing at that time. Now they are. And it was just very quickly you had this morph into all of these different shipping sectors that nobody was seeing, and these stocks that are just flying, like some of these talked about Zim. These things are just flying to a major degree. They look really good, and you're nailing all of these different sectors inside of the sector, which I think is very hard to do. And that's something that I'm trying to talk about more when I'm doing like our videos for the room, which is finding those sectors inside of the sectors, like finding coal, for me, finding coal stocks inside of the energy trade. Like, how do you find these certain sectors inside of it? And I think it's essential because you could have oil shippers kind of moving nowhere while you have another side of shipping moving somewhere. And you could have a trade, right, where you have like the idea of storage, the idea of energy, the idea of certain things, but it just might not look the way you think it should look. Maybe like tan in 2019. I would think that at that point, what we were looking at was oil kind of making sense at that point. You had all these things kind of working the right way, but instead, my better trade was in tan that year, which was the solar ETF, which isn't for me. I'll trade anything. I don't really have any biases. I'm not a fan of that exact sector, but if it's moving and it's making money, I'm happy to be in it. So you're kind of looking at all of these things inside of the sector, and you're seeing this disparity between the oil shippers and the other shippers. And so where are you positioned now, and where did you start positioning at that point when you started to see that change, and then where are you kind of moving into now?
Yeah, so I started out with just the oil shippers in 2019, 2020. And then I think last year when the news on the port of Long Beach, where they had huge congestion, when that news hit, that's when I realized that maybe the container ships have some pricing power. And then I started looking at Zim, which was a IPO last year at $15, and it's done extremely well. And I started looking at Zim. I looked at the charts, and I was like, "Oh, okay. I think I missed out on this trade." And then it took a while for me to actually look at the fundamentals of the company, and then I realized that no, I haven't missed out. This is an easy 10 bagger, and even now the valuation justifies it. So that's when I started to look at, okay, if I like Zim, then what do I like in the container ship space? So the container ship space, again, you can split it into two sectors. One is the lessors and the other is the lessees. So
Mhm.
the lessors are the ones which have the ships and they lease it out. And then you have the lessees, which are the ocean liners like Zim, which take those vessels, they carry a freight, right? So I looked at Zim, then I looked at the lessor segment, and I realized that there's value here too, because the vessels that they are holding on their balance sheet, they are going up in value because steel prices are going up and because shipyards are backed up and because demand for vessels is rising. And the debt that they have is no longer that difficult to service because vessel values are going up, earnings are going up, cash flows are going up. So the whole sector is kind of recovering from probably a decade-long bear market, which saw a lot of capital just going to die, right? So
Mhm.
now we have this huge upcycle, which I think has a lot more room to run just based on the fundamentals. So I mean, to cut the long story short, when I looked at Zim, then I looked at the companies which are leasing out the ships. Then I started following the Baltic Dry Index and realized that something's happening here too,
Mhm.
which turned out to be the other sector that moved up a lot last year. So then I looked at Golden Ocean and Starbulk, and I realized that yeah, there's an opportunity here. And then I discovered this kind of small cap, which interestingly was listed on the JSC, which is the South African exchange. And I realized that, okay, so if liquidity for this improves, then we are going to have a huge run in that too. And that turned out to be a pretty, I mean, that was a huge uptrade, right? So the stock is Grindrod Shipping that I think moved from around 16 to 25 in no time.
Mhm.
So
And Zim, from 15, it's at 69 today. These trades are just phenomenal, and it's and most of the time it's when you look at the major sector, let's just go from energy down. When you look at energy and you see it's up 150%. And then you can also go deeper into these things and find the subsectors inside that are really making those moves. And then you find something like shipping. And then you can continue to make these moves, and there's all of these things in there. And also, if you go really far out, if you look at, let's just look at Fro, for example. Um, we look at Fro and we go really far out, we're seeing that the 2008 high was $366. It's trading at $9 today. If you're a very short-term trader, you'll look at this and go, okay, this is run too far. This is overbought, this is overdone. But really, when you take that far out look, especially at the energy sector in general, like, it hasn't gone anywhere, especially if you do it relative to the S&P, which is kind of the best way to do things like that. If you look at it relative to the S&P, energy hasn't gone anywhere yet. If you're looking at Fro, Yearn, any of these names, they haven't gone anywhere yet. Yeah, there's some movement. Yeah, it's moved up quite a bit, but it's nothing that it can go a lot further. And when you really look at it on a very long time frame, it's almost like some of these things are just getting close to kind of a breakout. That's insane to think about after 150% run, or in some of these stocks that you're talking about, 300, 400%. These runs, so many people, they look at a chart, and if you look at it really closely and you go, okay, there's the top of the chart, that's resistance or something, or it's moved up, there's the old highs, that's resistance. There's lots of ways to kind of talk yourself out of a good trade, and kind of seeing that when you zoom out, sometimes it's the best way to look at things, because you can't really get a good look and a good idea of how far something can go just by looking at it up close. Something that looks parabolic on a short-term time frame could look like nothing on a long-term time frame. If you look at a monthly chart of some of the stocks we're talking about, you're not going to see anything. It's not going to look like, they barely moved so far. But really, if you get close, these things have moved 200, 300%. So, with that said, I'm kind of looking at all these energy trades as kind of like they're just getting started. With the commodities, like a lot of the commodities, yeah, they look good. Yeah, they've moved out a lot, but they could keep going. I can't see, it's one of those things where you can't really predict where this exactly ends up. You can't really say, like, for example, this trade is working really well and you're in it and you're going to move up stops and continue to stay in it, but there's no way to really tell where exactly that ends. You have to have a way of looking at it. You look at the fundamentals. You might find something fundamentally before you put on the trade that you're going to go, okay, well, I'm going to get out of it at this point. For me, I'm looking at the trends and I'm saying, when it hits this, I'm going to get out at this point. And as long as you have those things going, you can really ride some of these new, it's almost like these are new trends that haven't happened in so many years. And we kind of had the 70s situation here, where I just don't think many people know how to trade it. So when you're looking at something like this, it's just something so different that nobody's really paying attention to at the moment, that could go a lot further. And all of a sudden, all these things are on the news. Years ago, when I started talking about the commodity trade, nobody cared. It was nothing, like I'm talking about something that's been beaten in the dirt for 10, 50 years almost, if you look at it in a relative basis. But then it starts moving. It's the same thing with the shipping trade now, is like, it's just starting to move. This could be something that, 5 years down the road that it's, on every news station and everybody's talking about it. And usually that's not the time where we want to be getting into trades. We want to be looking at things like this when it's just starting to move. We're trying to find something new, because that's the thing about, even as a trend follower, I'm not sitting there and going, oh well, this has moved up a lot, I'm going to buy it. I'm trying to see when the trends are changing, and then that's when I'm going to come in and try to buy something. And that's what I'm seeing on this sector, is that we're kind of just getting started. And the commodity cycle in general, that's something that I think is really driving these trades, obviously. And so when we see this commodity cycle kind of picking up here, and we're looking at all of these things, what inside of the shipping industry is going to be the most affected by this commodity cycle? And you could go from soybean oil, food, whatever. I mean, even if we actually do get into a World War III scenario, just because people probably want to hear that. I don't exactly agree that that's the case at the moment. But if we come into a scenario like that, what do you think will be affected the most?
So, I mean, in any kind of Armageddon type scenario, you never know what's going to happen, right? Like ships get seized or whatever. But outside of the extreme cases, the most obvious thing is that free trades go up because the risk involved in transportation has just gone up, right? So free trades go up across the board. So that includes containers, dry bulk, everything. But right now, I would say the biggest opportunity is dry bulk because China is done with their winter 2022, the Olympics, all the restrictions they had on the they told the steel plants to operate below capacity, and then they had trouble sourcing coal because they were running out of electricity. So all those issues have been sorted now, and I think we are going to have a new upcycle in terms of real estate demand in China, steel demand in China, and overall the push of securing your supplies, right? So now with the Russia situation, every country is looking at their supply chain a bit more seriously. So I think we are going to get lot more dry bulk, which is soybeans, iron ore, coal, everything gets transported to China. And broadly, also the shortages that we are seeing, especially with coal, I think that's going to increased demand for stockpiling inventory, which should be good for the dry bulk shippers. So I think I mean I'm bullish on all three: the oil tankers, containers, dry bulk. But I think the next big move is going to be in dry bulk. And if you pull up the chart of the Baltic Dry Index or the BDR by ETF, it's kind of not done anything in a while now. It's
Mhm.
just been down. So I think that's probably going to be. I mean, fundamentally, that's probably going to be the next big thing.
Yeah. I mean, it's interesting when you look at everything kind of across the board, and you see all the agricultural stuff right now at the moment is just insane. Wheat, especially, for obvious reasons. And so you see all of these things, and for me, I kind of agree that dry bulk is kind of the area that's going to be kind of needed to be flooded into, if anything. And so we're kind of looking at all of these sectors right now. And kind of another thing we talked about the other day, which was the fact of trades not needing to be exactly what you think. For example, Russia falling apart doesn't mean you need to buy Russian stocks as they're crashing and they're being halted, trading. That sounds insane, but people are doing it, and people are doing it to an extreme level. And so what he just articulated well was the fact that there's other things and other ways to look at specific situations. He didn't just say, okay, let's just buy the RSX and call it a day. He mentioned that there's all of these other areas. So the RSX is an interesting one because it was falling apart before any of this happened. And that's kind of the premise of price action trading. Is it's not like anybody who tells you it's predictive, they're lying to you. But what it does tell you is what people are doing. And so people are getting out of this at a crazy level. And there was really no reason why. I mean, I got stopped out of it way before any of this happened. The trade went very well, and then came back and hit our stop, which is normal. We get a sell signal, we're out of the position. And then it starts falling apart like crazy. And then it gets under the 200-day moving average, and then everybody wants to buy it. And for me, what I'm seeing is that this is when everybody's kind of when you're looking at a stock falling apart like that, and everybody's interested in buying it, what I'm seeing is that something's going on there. Something is going on that people aren't talking about yet. And it's because price action trading is just what people are doing. So everybody's getting out of this for some reason. Maybe we're not hearing news about this situation happening. We're not hearing anything yet, but somebody knows that. Somebody has that information. Russia could be a great trader. The US senators could be great traders. All of these things are very possible. So somebody with money is getting out of all these positions and telling other people. And all you're going to see that in is the price. Oil's moving up. So, once again, that usually strengthens Russia, and it didn't. Energy is doing very well. That usually strengthens Russia, but it didn't. You put all this together, and there's a flight to capital leaving for some reason. You get it under the 200-day moving average, and now you're having an area where it's kind of under this good zone. You kind of really don't want to touch it at all, and everybody's flooding into it. So, what we're talking about is not buying something like that, coming into it and going, okay, there's all these other areas. For me, like Kashyap just named his, for me, I immediately thought of European natural gas. All of these areas are kind of very easy to see what could happen in the market. I mean, even oil was kind of easy to see that if something did happen, that would be the next scenario. So, there's all these different ways to look at things without just going, okay, I'm just going to buy the Russian stock exchange or look at this stuff. I mean, we talked about it the other day, how many people went out and bought certain stocks in Russia because they have very low PE ratios right now. It's like, yeah, I get it, but and yeah, that may be cheap. And I understand your point in that, but it's in a downtrend. It is crashing. There's everything telling you not to touch it right now. And that doesn't mean it doesn't bottom. It can bottom, just like things can top that are have no reason to top. All of these things can happen. But the point is that when there's a kind of a bunch of easier trades that are in front of you, that are not you buying something crashing, you're going to most likely make a much better return like that. And you're going to have a lot less risk. If I buy the Russian stock exchange right now, there's a ton of risk out there. There's everything that could possibly happen, even though, it's moved, it's like it initially moved down, 20%. And then it moved down 30, and then it moved down 40, and that just continues to go. And every 10%, everybody gets more bullish. I need to buy it more. I need to buy it more. And it's like, this is literally falling apart in front of your face. And there's 1,000 trades in energy right now. There's 1,000 trades in commodities. And that's why it's also good to look at the market as a whole. And also, like we're talking about gold and silver, you have this flight to safety in the gold and silver markets. So you kind of are going, okay, well, there's this trade building up too, kind of based on this situation, but in general, that could be a good trade. And you want to also know the environment. The environment's inflationary. The Fed, even though they say they're going to act, who knows? So we're kind of in this inflationary environment without much growth at the same time. So now we're in a stagflation environment. What does well there? Well, gold, commodities, these shipping stocks obviously are doing very well. All these things are doing very well at the moment. So it's why plow into the crashing stock?
Right, absolutely. And it's one thing to see retail doing it. It's another thing to see the fund managers doing it, right? So
Yes.
it makes no sense why a fund would want to do it with other people's money. A retail guy who probably, wants to brag about buying the bottom,
Mhm.
there it makes sense. But if you're a fund manager, you can, you have to look at the bigger picture, like for instance, natural gas, or look at LNG. So it's almost certain that LNG capacity is going to go up. So buy stocks of companies which are building LNG export terminals in the US, or just buy the companies which are shipping LNG or LPG, or basically the tanker trade again. So you have all these other options, or buy uranium. Kazakhstan is a ally of Russia, and it's one of the biggest suppliers of uranium for the world. So if you can buy a uranium mine in a territory which is not going to be affected by, say, sanctions on Russia or anything, then you can do that. So you have so many other trades that you can do instead of just going and trying to catch that falling knife. And for all we know, this ends with Western investors getting kicked out of Russia, with the shareholdings of Westerners getting nationalized. Because I mean, when you're pointing the swift weapon at Russia, you never know how they are going to react,
No.
right? And I mean, it makes sense to just buy wheat, right? Forget about everything else, just buy wheat, and you have a Russia trade on, and you're going to profit from it from the get-go, right? It's so easy when you just look at the second order or the third order, instead of just rushing into buying a Russian bank because it's cheap, or buying Gazprom or Rosneft. Or I mean, these trades just make no sense to me. Like, especially for a fund manager who has at least a little awareness of 1997, 98, when they saw the whole thing collapse. I mean, like,
Maybe they
why
don't.
do you trade? Yeah.
Maybe, and that's the thing. I think I started to notice more, especially after I got into the world a bit, is that I don't think most of them are more in tune with trading than most people who just pick up started their Robinhood account yesterday. Sometimes I watch them do things and I sit there and go, there's no way. Like there's no way they're actually, oh wait, they're doing that. Because it's like you said, it's easy to come in and want to brag. I bought the bottom in this and I want to tell everybody. It's not going to make you any money because you can't do it again and again, and you're probably going to lose a lot of money on that way to that bottom. But we can understand from an ego perspective. But if the point is to make money, and that should be your point in trading always, you have to wait for certain things to happen. This thing could blow over, and something crashing, you never know where that's going to stop. But if it starts to hit a range and gets stuck and isn't breaking below that range for a little while, and then it starts to move up, that's going to happen before war ends, or whatever's going on ends in any situation. So it's the same as COVID. You got the situation of the US. We're literally shutting down as we're bottoming in the market. Like that's literally what happened. So all of these things, price action is kind of usually forward looking. You see this bottom happen 2009, you have March 2009, markets crashing to a new low. But when it bottomed was way before the recession ended. And this happens over and over again. So it's a kind of keep an eye on the price action if you really need to buy the RSX. I mean, we're not saying that, but I'm saying that there's a way to do those things that's not like that. I would rather, I see agriculture and everything, from wheat, corn, soybean oils, soybeans, whatever across the board, basically coffee, cotton, softs, lumber, copper. I could go on forever, but all these things are in nice uptrends. They're moving nicely. If they aren't in uptrends, they're consolidating and ready to break out into a new uptrend. That's going to get me very interested. I'm very interested in trying to trade something like that. I am not interested in trying to buy something that's crashing. It's only ego driven. It's not making you any money. So I guess I'm ranting now, but please just stop. Please stop doing that, because it's just like you said, like I think you put it well, where it's you want to brag to your friends, but wouldn't you rather keep your mouth shut and actually make money?
Yeah, absolutely. Yeah.
But so looking through these now, so are there any countries that you are looking into that have something interesting going on? And that could be a stock inside of a country, but go from the macro of the country into why you're thinking about that.
So I'm looking at Sri Lankan stocks. So that was kind of the purpose of my last trip.
Mhm.
I did a backpacking trek across one part of the country, and it's an interesting situation because the entire stock exchange is around $27 billion in market cap. That's it, and that is at the official exchange rate of 203 to the dollar. So if you use the black market rate of 246 to the dollar, then that's like around $20 billion. And the interesting dynamic is that this is a country that's very rich in natural resources. It has a deep water port, which makes it a shipping hub, and it's basically export driven because they have tea plantations, they have agriculture, they have textiles, so they have enough water, which is another thing that's going to catch on pretty soon. So they have all these things, and the problem is the currency. So the central bank has the currency pegged at around 203, and the peg is probably going to break because they are completely out of forex, they are completely out of diesel. They shut down their only refinery because they couldn't afford to import crude oil and pay for it.
Mhm.
But I think when this crisis resolves in Sri Lanka, it's going to be a massive opportunity simply because you look at the country and you see that society isn't falling apart. Even with the money supply went up 40% in a year, and society isn't falling apart, which is very interesting because usually in these kind of situations, you would imagine it going the way of Venezuela or Cuba, where you have crime rates rise, you have gangs come in, you have violence going up. You have
Mhm.
none of that. It's a very peaceful society which is just on the cusp of a collapse. So I think that's going to be a country I'm going to be really getting into once the currency peg situation resolves itself. Other than that, I like Denmark,
Mhm.
uh, mainly because it's services driven, but at the same time they have a strong agricultural background. So Denmark, there's this company in Denmark which is one of the biggest milk producers in the world, and we talked about this. We are bullish on any kind of agricultural commodities across the board. So
Yeah.
that's one country I would be, and also Denmark has. It's again a peaceful society, high net worth. They have pharma, they have industries. It's
Mhm.
actually a big industrial hub. So when capital shifts from service based, which is your tech, to something more intensive, it's going to benefit the commodities, but it's also going to benefit the manufacturing side of it. So
Yeah.
I think that's another country I would be looking at. So these are just ideas for, when something happens rather than a right now situation.
Yeah, and that's an important distinction is that, getting bullish on something like, for example, 2019, getting bullish on commodities, getting bullish on shipping. It may not have worked, but that doesn't mean like the trade needed to be on. The trade doesn't exactly need to be on because we're kind of in that situation of going, okay, well, this looks good, but we also want to see something happen. We want to see change, and that can be rate of change in the fundamentals of the overall economy, where you're just seeing growth starting to tick the other direction, meaning up. We're looking for that across the board on whatever we're doing, because for me, I want to at least understand that something's going the right direction, even in a society that's a communist society or a socialist society. So many people love to just go, screw that, I'm done, they can't do anything well, they're socialist. And really it's a, what direction are they moving? Are they moving more that direction, or are they moving the other direction? And that's really going to kind of get you your first steps into a good macro trade on a country, because most of the time everybody's so focused on things they don't like. If you like socialism, you're all about that country. If you don't like socialism, you're not about that country. So it's really the, can you come in and understand that that's changing to the right direction? And as long as something's changing the right direction, I mean, even Russia, 2019, which is a good trade, Greece 2019, which was a good trade, Brazil, these things were heading in a specific direction at that year. And that's why those were good trades that year. So you can kind of look across the board and see like what you're talking about. Denmark is very interesting. Also, they have a lot. They produce net nuclear energy as well, right?
Yeah, I'm not sure. I think, yeah,
Yeah, so I mean, across the board, there's a bunch of very interesting things in those areas, and I don't think a lot of people. I think a lot of people have just kind of thrown that whole area away and said, "Screw it," I don't want anything to do with it. And so there's a lot of interesting valuations in a lot of those areas, and so we kind of always see these trades set up where it's if it's a country that produces a lot of resources, has a lot of farming, a lot of people forget about it during a certain part of the cycle, like when tech's booming, like we're talking about. When tech was booming, everybody was hating those countries, thinking there was nothing to do. I'm not going to buy it. I'm not going to touch it. Look how bad they've done. But then everything kind of shifts and changes as these are resource-based countries. And now, next thing you know, these are areas that you're going to want to be really paying attention to. So I think that we're kind of looking at all this pretty similarly, where we're seeing this agriculture trade still have legs. That's the thing. Like, you look at corn, you look at soybeans, you look at any of these things have moved a ton. But that's not doesn't mean it's over. That means that something is still moving. And most of the time, when money is flowing into something, you're seeing that relative outperformance, especially right now. Like, if there was ever a lesson in relative strength, it was this year. Energy and energy-based sectors have done very, very well. Commodities have done very well. Everything else has not. And you've seen those things have moved up for a year now. Energy was the best performing sector last year. All these things were the best performing areas to be in. And so I see so many people, especially lately, fund managers, I'll have conversations with them and I'll be like, hey, we'll not even ask them. They'll talk about how they did in 2021, and all of them had a miserable 2021. And I had a good 2021. And, we're having conversations about it. I'm not understanding like what they're doing. And because tech has gone up for so many years, they continued to buy more tech stocks. They continued to just get sucked into those and do that over and over again. And so kind of looking at it and going like, there's so many things out there to trade. Right now we're talking about commodities and so on, but I trade tech too. It doesn't matter to me. And there's just, you want to be in what's going up and not in what's going down is really the simple answer for this. And so as you're seeing all these things kind of move into these areas, don't write it off because it looks crazy. Maybe wait for an opportunity. Maybe wait for something to happen in those areas. It doesn't mean just buy it as it's skyrocketing. That means there might be an opportunity that comes up in these areas. Maybe take your time and get into those trades. So, anything you want to end on? Anything you're thinking about right now that we didn't get to?
yeah. Like, I just want to say one thing about your the fund managers in tech, right? I mean, last year the narrative was it's an exponential age, so forget the corrections and just ride the uptrend. So
Yeah.
I think a lot of people just got suckered into that because that was made very popular by the Twitter personalities, right? And then you had all these kids making crazy money off NFTs and stuff, and then you had the fund managers with the performance pressure to just follow that. And I think that's where sometimes they just swallowed their own narrative without seeing the broader cycle.
Yeah.
And yeah, I mean, the fact it's not a surprise to anyone now that inflation is no longer transitory, right? So I mean, everyone knows it. So why are you still buying tech when it's not the right environment? Well, because you know it's the
Yeah.
exponential age or whatever.
Yeah.
And it's also the easiest trade to make because you have made it for so many years.
Yeah.
And Apple was a trillion, $3 trillion, and all
Yeah.
these stocks are like worth $1 trillion. And it's just been so easy to do for so long that people are going to keep continuing to do it, even though it's no longer the right thing to do. And I absolutely agree that even now with wheat taking off or coffee taking off, no one even wants to look at it, right? I mean, people are
Yeah.
still asking you about, maybe they're asking you about the lumber trade or the Bitcoin trade and
Yeah.
not about the wheat trade. Or maybe they're asking you about the crude oil trade, right? Like, No one wants to
Crude,
look at
yeah.
coffee or, I mean, vegetable oils. Who's talking about vegetable oils? No one wants to talk about vegetable oils. Like in India, because vegetable oil is the cheapest form of refined oil people use in their cooking, they are talking about it.
Mhm.
But they're not thinking about buying the futures, right? They are just crying about the fact that their cost of living has gone up. And that's pretty much the awareness people still have about commodities. So I think we are very, very early. And you also have to look at the other part of it, which is with crude going up, electricity costs going up, the cost to produce fertilizers goes up, which
Mhm.
means the input cost for this entire sector is going to go up. And with COVID and all the lockdowns, the migrant labor which is going to farms, for instance, Cambodian laborer going to Vietnam for farming. So kind issues like this, they have all taken a hit. And if you're not getting illegal immigrants to California, then who's going to pluck your blueberries, right? So you're going to have all these other issues, which I think it's just a setup for a long, long commodity cycle. And I think we are still very early, even though, you probably see the charts and it look like, oh, wow, maybe I missed the trade. But I really don't think this is it. I think we are just beginning.
Yeah,
So,
and on another point that you brought up, which was talking about tech. ARC, I saw the other day, there's a piece of research where somebody made ARC against oil, and like I hadn't even thought of putting that on a chart. I don't really look at ARC more than once in a great while to just go again, and if you'd have talked to somebody, a year ago, 2 years ago, it was everybody's thing, get by this. Kathy was a genius, like you said, the exponential age, you just keep buying things. I don't like, what the hell does that mean, and that's why I always try to say, like, the way to think of things is like as yourself as a trend follower, like, because you have to understand when a trend has changed. You just have to. There's nothing, like, you can guess at tops, you can guess at whatever, but buying things when the trend has changed to down, that's going to kill you. Taking profits isn't going to kill you. It might take away from your major returns in the end, but it's not going to kill you. But what will kill you over and over again is buying things in massive downtrends. ARC is in a downtrend. Every single person wanted to buy it. Let's buy it. I mean, and there's been so many people who put up those God, what are those called? Those voting things, where basically you can either pick ARC or oil, and every single person always picks ARC, over and over again. And still to this point, everybody's still picking that. And granted, like, I really don't want to buy, I wouldn't be buying oil if I wasn't in the position already over, where it's at today. But once again, it's a, what exactly has to happen for that shift to happen, like, where you go, oh well, I've lost everything buying this thing that this person, I mean, as a trend follower, what I'm looking for is the outliers. I'm looking for these massive moves, like oil going from nothing to everything. That's the type of moves I'm looking for. And Kathy Woods got on TV the other day, and I caught this clip because a buddy of mine sent it to me. He's like, "You got to watch it." And I don't watch the news or any of that at all, but he's like, "You got to watch this." And so she comes on and she says, "Oil should have never been over $50." And I go, there is no average price. There is no, this price should be in trading. There is nothing like that. And she goes, well, the reversion to the mean, like, would have meant that oil at the most could have possibly hit 60, and it would have never gone over that, and it shouldn't be. And therefore she started talking about tampering and, like, all of this stuff that you're just like, you just can't say you're wrong. like, and then she's talking about buying more of these stocks, these not energy, these tech stocks that she's in, and these solar stocks, and she's talking about buying more and more of these things, and so on and so forth. And it's like, are you missing something? Like, like, and not to mention, there's just a thing in trading where you just have to be wrong. Okay, I was wrong. My fund ARC is just an investment into that asset class. If you want exposure into that asset class, you can buy our fund. That's how you put that. You don't say, I am a trader, I am a money manager, I'm running this for you, because you're not. You're just buying that sector over and over again, thinking that it's going to go up because you have a view. And her view could be right in 20 years. I don't know. But I'm saying that in the meantime, are you willing to lose 50% a year, like until that point? That sounds insane. And as a money manager, for me, I have to make sure my yearly, I want my quarterly returns to be good. I want my yearly returns to always be good. I'm trying to do that over and over again because that's my job as a money manager. You're not always going to hit that perfectly, but you're going to focus on that and try to do that well. But then you have somebody like that, and she's just trying to get as much capital as possible with a cool idea. And that's really what, a lot of the funds are driven by. Like, get as much money as possible, keep pumping it in as much as you can. And then, if anything was to ever, go terribly wrong, then you just say, well, yeah, I was just giving you exposure to that sector. It's crazy. And so I mean, I understand the point of some of these things, but if you really are a manager, you have to understand that there's times where you're just wrong and you got to get out of certain trades. And as a trend follower, I think that's a little easier because I can go, okay, the trends changed in oil. Now I'm going to I went from short and I went from shorting it to long. And that was easy to do because I have a system. I know when I'm right. I know when I'm wrong because the price is going up in my account or not. Like it's not because I think I'm right. It's because my account's going up. So yeah, I agree. It's just like watching that situation over and over again is so frustrating because it's like like you said with vegetable oils, like the canola trade, the soybean oil trade, like these things are just starting to move. And some of these things are just, they have insane possibilities. And especially because there's not one person that's going to be sitting there and go, like normal person going to go, man, I should really get on that canola trade. Like there's nobody who's thinking that, like there's nobody in the world who's going to think that. But that's the trades that make the most money. Because if it's on the news, like most of the time, that's the end of the trade.
Yeah, absolutely. Yeah. And I think with canola, it's Canadian, right? So it's not that easy to access.
It is if you're, if you have access to futures, it's not bad. All the exchange, the TD, interactive brokers, all of them have it now. But it's so, a lot of times, especially ice products, people don't want to spend the extra $5 a month, like they'll get killed I get so many people who talk about futures and the data fees, and they're like, man,
Yeah.
it's like $5. Like, yeah, or like it's like $50 for like ice now. And it's like, yeah, like you get access to products that are global by this, that will diversify you, which will pay for that small expense over and over and over again. But you can only say so much.
Absolutely.
Well, all right, man. It was great to talk to you. And we'll talk soon. Thanks for coming on. It was just awesome to hear from you and talk about the shipping trade once again, because I think it's something that so many people are talking about it today, and I kind of wanted to bring you on because I know how much you put into that and how much, it's probably like for like especially you writing it and doing it on that level, it's a kick in the teeth sometimes when you see everybody talking about something like they just discovered it, and it's like I'm over here, just doing it. But and not that you do it for that reason, but like I wanted to bring you on and kind of go through that for that reason.
Yeah. Thanks, Jason. It was my pleasure.
Of course.